Hey everyone, welcome to another episode of Portfolio Talks. Today we're going to be talking to you dentists who are looking to buy a clinic. So perhaps this is your first clinic, or perhaps you're buying your second, third, fourth, and becoming the Warren Buffett of the dental world. So there's a lot of considerations you want to look at when it comes into buying a dental practice. We're going to go through and break down some of the nuances, demystify some of the numbers, and just simplify everything so you have a good framework of a thought process to enter into clinic ownership for dentists. And as always, if you appreciate the podcast, if you learn from the podcast, do us a favor and subscribe and share so your colleagues can also learn and benefit from this as well. And with that said, let's jump into it. Another episode of Portfolio Talks.
Hey, getting money is my job. Come and pull up to Portfolio Talks. Hey, paper stacking round the clock. Time to pull up to Portfolio Talks. Yeah. Portfolio Talks. Hey, Portfolio Talks.
All right, episode 12, Portfolio Talks. Today, dentists, we are talking to you guys about buying a clinic. And this is going to be one of the most important decisions of your career if you're transitioning from an associate dentist to being a full-fledged practice owner. We want to make sure that you have a good general idea of, not all the complicated stuff. Like here's a 45-page document with 17 checklists for you to do. It's just very simply, what are you looking for and how do you start to get an idea of, is this clinic good? What things should I start to put in place? And then you can lean on your professionals like your lawyer, the banks and things like that to make sure that you are getting, the information that you need to be able to vet a good deal and turn a profit quickly. And then perhaps move on to your next one, or just start to use that money to build your own personal wealth and retire and enjoy, the rest of your life, because a lot of you will have high income earning years. We want to enjoy that money as well. So making sure that you enter the right deal is the big difference between buying a landmine or buying a jackpot. And a gold mine is what I meant to say. So, those two things can be very different. And the thing to understand is you guys are private practice. So it's not like your physicians where you can open up anywhere and your clinic's going to be good to go. And there's a backlog of 70,000 people waiting for a family doctor. You are competing against every other dental clinic or specialist that's going to be in your area. So, what do you do and how do you turn a profit on that one? So as always, you have myself and you have Tyson here as your host. And as a reminder, we have a closed Facebook group for those of you doctors across Canada. So if you want to learn more about these topics, you can feel free to join that. As always, it's going to be in the show notes, and you can ask your questions and we'll start to do mailbags as well. This last episode, we want to go a bit more to the numbers. This episode, we're going to go on more of our overarching advice, and then we'll probably switch back in the numbers next episode. So we want to do a couple different styles. So depending what type of listener you are, you have an episode that fits your flavor. So for this one, we're going to keep it pretty high level and not go too much into graphs and charts and all that kind of fun stuff. But we're going to talk about valuations for dental practices, asset versus share sales, which one's better and which one you want to look at. We're talking about bank financing and how you can get financing to buy your practice, potential conflicts of interest that brokers have, and should you use a one-stop shop or should you, break it apart and have different professionals that are working separately and in silos to make sure you remove the conflict of interest. We're talking about patient retention, and then we'll wrap it with some general stuff. But Tyson, I just talked a lot. What do you want to share before we jump into it? I know you were golfing this weekend. You almost did a Masters thing. I think you golfed, 2 days, 3 days?
I did 2 days last week. It was good. It's summertime, so we're trying to get out and golf as much as possible. I got in 2 rounds last week. Went and played with one of our business partners. We played Northview. It was beautiful. Man, what a difference when you play like a super nice course and the tee boxes and the fairways and the greens are just premium feeling. So nice. They're fast, right? So if you miss a putt, it's running for a while. But I shot a personal best, and so that was awesome. And it was casual because I didn't realize I was trending towards that until we're on the second or last hole. It's like, man, I'm doing a lot better than I thought because we were talking most of the time. And then on Friday, played a charity golf tournament, and we played at Westview Plateau. It was run really well. Great turnout. Tons of people. Good golf. Even at the beginning, we had thunder and lightning, but we weren't sure if we were going to get called off, pushed back, like what was going on. That was kind of weird weather. But I think it actually helped us with the greens and the fairways, keeping them a little damp. And so you didn't get as much run off, because if you're not accurate on that course, you're going to lose some balls. And we did.
Yeah, it's crazy the difference. I think the last round I shot was at Vancouver Club, the Vancouver Golf Club, and it was like lightning quick. If you miss your putt, if you miss your line by like an inch, that thing is gone. Then you have to chip back onto the green, and it's brutal. Like it's tough. It's frustrating. But I do remember the days when I first started golfing, and I was on these pitch and putts where it's just mud. Like you're standing in mud. You're like, oh, this is nice, and you start learning to golf, and then you go to the nice courses. You're like, I would never go backwards. So it's one of those things that you take the difficulty and you're happy with it, but it's a patient game. And congrats on the personal best. That's unreal. I had my personal best.
Thank you.
All by one of my worst rounds earlier in the year. So it's hopefully you don't get that.
Yeah. Yeah.
Awesome. Okay. So let's jump into it. So one of the first things that, we want to tackle is the acronym that everybody hears about that most people don't even know what it is. EBITDA. What is the myth of EBITDA? What is that?
Yeah. EBITDA is something that accountants use. It gives you an idea of value of your business without relying on top line revenue. Because some companies have really, really high top line revenue, and then you look at their next number, which is expenses, and their expenses are equally as high. So they're not making any money. They're not profitable. So the acronym of EBITDA, earnings before interest, tax, depreciation, amortization. So they're looking at a lot of stuff. Essentially, when we pull out all of the noise and all of the fluff from the numbers, what is the actual profit? Like, what is your company actually doing? The reason EBITDA is a nice number to know is some industries will value your business on multiples of EBITDA and not multiples of revenue. So it's good to know which industry you're in. How does that work? Is it working for you? Is it working against you? Without you having to have an accounting degree or background.
Yeah, and I like that explanation. It's really just the true profit of the business, and when it looks at like interest, tax, depreciation, amortization, those are really the big expense items besides, for most businesses. So it's actually looking at what the true profit is. I think that's the simplest way. Instead of EBITDA, when you hear it, just think, what's the true profit of this practice? Because revenue is an easy thing to drive up, but oftentimes it takes more money to make more money. So you want to see what the profit margins are. And those are going to be really what dictates a really, truly well-run practice. And that's what we want to be buying into as a well-run practice. And if it's not, if you look at why it's not so profitable, and you can solve those problems, you have experience solving those problems, then you can buy it at a discount and turn that profit even quicker. So sometimes, lower EBITDA or things that don't seem ideal, they're distressed assets. Those are sometimes, if you have the specialty to fix it and the appetite to fix it, because obviously it's going to be more work, or you have your own staff from clinic 1 that you can bring in clinic 2, then those are things that perhaps you want to be looking at as well. So EBITDA, you can look for the best, or you can also look for the worst. One thing I always find interesting, because we've been helping clients with their acquisitions over several years now, but comps are always an interesting thing to talk about, because usually if you're listening to this, when you think of comps, you probably think of real estate. Like you're looking to buy your first home. Okay, your realtor will tell you, okay, comparables in this area or comps in this area are this price, this price, this price. It's not always the same thing. So not all comps are truly fair comps. And what I mean by that is Dental Corp. Dental Corp is something that had a big change fairly recently. So, people know about Dental Corp. They recognize the name. We had one client who was looking to buy a practice, and the seller was giving multiples that Dental Corp use as the comps. Like, well, yeah, Dental Corp's the biggest one. And obviously they have their argument was Dental Corp has the most resources to vet the right deal. So they should truly be the benchmark of what you should be valuing my practice at. And, who could value better than Dental Corp? But that's not very true at all. So, why would Dental Corp have higher multiples than, a mom and pop dentist looking to buy a practice?
Yeah. So Dental Corp's business was buying up practices and creating a workflow that is more profitable for everybody that falls under their umbrella. And I think they can value at higher multiples because of their economies of scale. So they can get the deal, pay the dental practice very handsomely, but also have them stay on, because you don't want to take over a practice in that structure where you're trying to build an umbrella of essentially franchisees. you want the dentist to stay on. You want to maintain business. You want it to stay business as usual with improvements. And so Dental Corp was offering higher multiples in that sense. And they had a system. And side note, side story, in one of the companies that we work with, they had Dental Corp in their private, in their Canadian equity sleeve, and it actually went private last year. It was bought by private equity, so it left the public TSX market and was bought by private equity. We got a very, very handsome exit on that. You usually get a 25, 30% exit on the premium. So if the stock price is trading at $100 a share, you're going to exit at 125 or 130, which is very nice for shareholders. So side note, people who are in that portfolio, that was part of the Canadian equity returns last year, which were really, really good. But I think that is their playbook. So their multiples are higher. It sounds more attractive, but is it realistic for a one-to-one? So in the instance that we are going to change hands, so if you had a practice and I was going to buy it, I'm not managing 300, 400, 500 practices. I don't have economies of scale. It's a one-to-one transfer. We have to be more reasonable with the numbers.
Yeah, absolutely. And I think another thing of why those do so well is it is a franchisee model is a great reference. And that's kind of what you see. And we see this often, whether it be FYI doctors, whether it be chorus in the orthodontic space. There's a bunch of different examples across different industries, but they can also attract a lot more associates because you can be more competitive. You have more money, you have more scale, you have a bigger market. So whether you're an associate that's wanting to work in BC and then eventually relocate over there, whether you want to look at your career trajectory and like, okay, well, if I work here, I can get buyout options, then buy a clinic that's going to be financed through the parent company, and then all these things are more favorable. So it's quite smart, and I don't see that really going anywhere. If anything, it's happening more. That's kind of like the world nowadays is private equity and is bleeding into everything really. But to Tyson's point, it's not a fair comp. So I think the blended rate was like 6.5 to 7.5, roughly for Dental Corp when they're buying their clinics, and they had like almost 600 locations. So like that's insane. So that multiple isn't always be the same of what you're looking at. Could be higher, could be lower, but you really want to be looking at what are the comps in your area, because every small town, are you rural, are you urban? What's the specialty treatments that are being provided at the clinic? What can you add on to the clinic? All those things go into the factor that you want to be looking at when you're buying a clinic, and just working with a good realtor to look at comps, to see what was sold recently, what are the details of that purchase, and your lawyers can help you with that as well. And we're going to come back to Dental Corp because when we talk a little bit later, we're going to be talking about shareholder agreements, associate agreements, staff agreements, all that kind of stuff, and why that's important. So remember, Dental Corp, we'll come back to it as an example of the importance of getting those agreements in place. Awesome. So when you get to that point, let's say you find a clinic and you're, okay, cool, I like this, Tyson Nagasaka Dental Corp, that's perfect. It fits, what I'm looking at. I want to buy it. You want to sell it. Awesome. There's two different ways we can do that. Asset sale, share sale. And they're two kind of different, but kind of the same things. So to simplify it, when you're looking to do a transaction on a business, as a seller and as a buyer, you're going to make an offer. So the buyer would most likely want an asset sale. Reason being is they protect liability. They're buying the assets in Dental Corp in this example. So, goodwill, dental chairs, delivery units, imaging equipment, sterilization tools, precision instruments, all that kind of stuff is going to be part of the assets. So I'm going to be buying all of your assets, and then I'm going to start using those assets to generate revenue. It's clean. On the flip side, the sellers would usually prefer a share sale because they can use lifetime capital gains exemption, which will allow them to knock out a big chunk of the money tax-free, with a caveat, and we'll get to that in a second. But the risk for the buyer is you are buying the shares of that corp. So any, pending litigation issues or skeletons in the closet are also coming with that share sale. There's ways to mitigate that as much as possible by using a good lawyer, doing due diligence, things of that type. But that's generally two different ways that people will do a transaction, is either an asset sale or a share sale. One thing to keep in mind is generally the numbers end up being very, very similar, no matter which way you offer it, if you're doing it correctly. But guys, I'll let you jump in here before before I go into more details about it. But asset sale, share sale, how does that break down?
Yeah, I mean, I think the one that we see the most common across some of our different pockets that we work in is a share purchase or a share sale. For the reason that you talked about is the mature, seasoned professional, they're trying to exit their business and access lifetime capital gains exemption. And we haven't been involved in a heavily confrontational buy where the purchaser wants an asset purchase and the seller wants a share sale and they're at stalemate. I don't think we've been part of one of those yet. I can see where that comes in though, in that, if you're following the advice of your tax team and your legal team and you want to sell your practice, they're going to advise you to do a share sale. It just makes sense. You want to use as many advantages as you can getting in and out of a business. But yeah, I agree with what you said is like the only downside to the purchaser is potential liability in buying the shares. And that's where due diligence, a good legal team comes in. Like, let's go through it before you write a check.
Yeah, absolutely. And yeah, thankfully we haven't been in any messy ones. But one thing I want to talk about is when you get ready to sell your business, it isn't something that should be a knee-jerk reaction where it's like, okay, cool, an offer came in and okay, I'm going to sell it. Which way should I use asset sale or share sale? Only time that's ever happened, we have seen that. The only time we've ever seen that is when it's something like a private equity fund or a dental corp that comes in with a crazy multiplier where it's like, wow, this is nuts. Like I got to kind of take this while it's here. And whatever, it's fine. It's a little bit messier. It's a little bit more hectic, but a tax treatment isn't ideal. We can make it work. But to take advantage of both of these as the seller, you really need to be preparing for your sale many years before it happens, or massaging your finances to have it happen. And one thing that we see as not ideal when people do, let's just say asset sales, for example, CCA recapture is one thing that happens quite often on that side because of the dental corp. You have so many assets in the dental corp, as I mentioned before, for dental equipment, specialty equipment, precision equipment, computers, all these kind of things. To simplify, CCA is really each item that you buy is going into a bucket that the CRA allows you to depreciate over several years. What they won't allow you to do is, hey CRA, I bought $50,000 of equipment. I'm going to take a $50,000 deduction year one and wipe out all my taxes. They don't like that. They like to give you stuff in buckets or in tranches. That's essentially what CCA is it allows you to depreciate over several years that piece of equipment. So a $20,000 piece of equipment, let's just say 5 to 10% depreciation every single year, and that happens. However, if you sell it and you sell that for more than what's remaining on your deduction, so it's 20,000, it's been going down over time because you've been depreciating every single year, and there's only 5,000 left, but you sell it for 10,000. Now the CRA is going to, blow the whistle essentially and be like, well, we actually give you too much of a deduction. You need to add that back. So CCA recapture, hopefully that made sense, but CCA recapture is a consideration when you're doing a asset sale from a tax perspective as a seller. So making sure that you have things available for you to offset that potential tax bill, such as your CDA room, that is very important. And we talk about this with clients all the time. So if you're looking to sell your practice over several years, you want to make sure you start realizing some unrealized gains within your portfolio and start to open up CDA room in your corp, because then that can allow you to mitigate the CCA recapture when that happens. And that can also be true for your share sale. And we've seen this as well, where there's a share sale and they use lifetime capital gains exemption, which is great, but there's something called AMT, which we won't go into in this episode, but it's essentially like a backup tax that CRA has. So if you are not going to pay tax, such as a lifetime capital gains exemption, and you try and swing all that money onto the personal side, the CRA is also always calculating AMT tax on an annual basis. Generally, your AMT tax is lower than what your actual tax bill is, so you never see it, you never hear about it, it never impacts you. However, in years where you wipe out your tax, like the lifetime capital gains exemption, the AMT tax is actually going to be the higher one. So you would actually have to pay AMT tax, and it's like an account that you get back similar to the CCA over several years. So I know this sounds really complicated because it is, but there's a lot of different moving parts on it. But essentially what you want to do is, if you're getting ready to sell in like I don't know, 2030, for example, start preparing your finances now. See if you can start opening up CDA room now, because that can allow you to remove some of these tax traps that are sitting there for you. I don't know. I feel like that was complicated, Tyson.
Yeah,
Is there a better
let's
way
do
to
it. Let's
explain
do
that?
a quick recap, and
Yes.
I'm only going to cover the acronyms.
Perfect.
CCA, capital cost allowance, right? So that's what that stands for.
Yes.
It's just the cost, a deductibility of goods that you've bought in your business. CDA room is capital dividend account. This is a way for you to flow tax-free money out of your corporation. CDA. AMT, this is alternative minimum tax. It's always running in the background. Your tax software, your tax prep team, they're always running an AMT number in the background. You just don't normally see it unless things are going to be very favorable for you. Then CRA would say, you don't get what your tax preparation team has done. You actually have to pay the alternate minimum tax, which is AMT. What was the other one? HST, GST? We didn't cover that one.
Yeah.
But that was a acronym heavy segment.
Yeah, very heavy acronym segment. But when it comes to the way that you're going to be selling your business, your CDA room can really help you on the asset sale side. And then when it comes to the share sale side, you get the lifetime capital gains exemption, which is great. But you basically need to show income to be able to get all that money tax free, basically. So oversimplification, we'll go through that part on a future episode. We can share some charts and some numbers and some examples that'll help clarify that a little bit. But the point being, there's usually what we see is there's two offers that are given on the table. One of them is going to be for an asset sale for the buyer, and one of them will be for a share sale as a buyer with two different numbers. And usually ends up being net almost the same for both parties, which is what it should be. And it really is beneficial for the seller of like, hey, if you haven't had, and we saw this actually just recently with a private equity buying one of our clients' clinics. But the good thing about it is it benefits the buyer. Sorry, it benefits the seller, because the buyer's like, in that example, I know it's quick, so you may not have purged your corporation to be able to use the lifetime capital gains exemption. So here's another offer, and you work with your team and pick which one makes the most sense, which is really awesome to see. But more or less, your net should be roughly the same. But just prepare your finances, because to use some of these tax avenues that the CR allows you to make it more as profitable as possible, it can't be a last minute tweak or a last minute thing. You got to have it over several years. So lots of acronyms, super heavy, but that's it for that side. Generally speaking, asset sale benefits the buyer and a share sale benefits the seller. And there's ways to mitigate as much as possible. Having a good lawyer is of the utmost importance when it comes to that kind of business transaction. All right, go to the more simple one of that transaction. So now we've started off with at a quick high level, how do you evaluate your potential clinic you want to buy? So another dentist that's going to be looking to sell, you'll probably have to do an NDA another acronym, a non-disclosure agreement, and probably a commitment letter to buy the clinic. They'll share the financials with you. You get a rough idea of what the EBITDA is, which is the true profit of the clinic. You can see the things that are dragging it down. If you have the specialty or the experience or the appetite to fix that and make it more profitable, that's great. Now it goes into step 2, which is I'm going to make an offer. Am I going to do a share sale or an asset sale? Talk to your team, work with a lawyer. All that's great. Now it's going into the finances. How do you get the money to buy the practice? Banks love you. That's the good news. You're a dentist, banks love you. So you'll get pretty much 100% loan to value from anyone you really talk to. What we mostly see is Scotiabank and CIBC have been very heavy in the last few transactions with their clients. But roughly they'll do 100% loan to value. Pretty straightforward. They'll also give you line of credits for operating. So if you need to do any kind of renovations, buy some equipment, things like that, you can do interest only options for the first year. Sometimes we see 2 years, or you can just start paying down principal right away. And that is really depend on what your strategy is. But maybe the strategy is the important part that we should talk about here. So banks are banks. They love you as dentists. They'll give you the money. That's not a problem. Do you do 100% loan to value? Do you do 80? Do you do 90? What is your strategy? So Tyson, if we want to tackle that one.
Yeah, I mean, I think if you are buying a practice that is extremely profitable and it's set up, doing 100% loan to value, it may seem a little bit less risky than if you're buying one that you have to rebuild and you have to rebuild the clientele, or you have an aging clientele. where you'd have to, essentially market and get replacement clients for your aging clientele who may no longer be seeking dental treatment with you. So 100% loan to value, it sounds really good. It's risky. You might take a lot longer to hit that break even point, or start really like paying down your outstanding loans to the point where you feel profitable and you can start breathing. Going into the deal with some money as a large down payment is ideal. It's a lot like buying a home. I still like the recommendation of going into a home with 20 to 30% down. Otherwise, you're considered like a high ratio borrower. And on the home side is we have high ratio insurance on these mortgages, default insurance. But on the business practice side, I mean, you assign life insurance to the lender essentially. I'm more conservative. I'm a little more traditional. I like buyers to go in with some money to the deal and have skin in the game. And there may be some unique numbers as to why you wouldn't want to do that. Like you might get a extremely low interest rate because the banks do love this sector. And so I think, again, is doing a little bit of due diligence. Don't fall in love with any one particular lender. You can talk to 3 of them. It doesn't cost you anything to talk to them. It costs you time. And see who's going to give you a good deal, because exactly like you said, they're going to give you a purchase loan, which is huge. I have heard some of them say they'll do $1 million without doing much underwriting. Lines of credits, operating lines of credits, credit cards with like essentially no limits. And then some of these institutions will offer you access to their private banking, some other things. I mean, coming from a banking background is they want you to have as many product lines with them as possible, because it's impossible for you to change down the road. And they love dentists. So you got some choices. You use that to your advantage.
Yeah, everybody loves you, which is a nice thing, right? I'd rather have everyone love me than everybody hate me, so that's always nice.
Yeah.
And yeah, so really it comes, from my perspective, it comes to whatever your next step is dependent on what you're putting into the deal. I see the school of thought for having skin in the game. At the end of the day, you're working in the clinic, so you have skin in the game because you're liable, you're the guarantor for the loan. So when it comes to how much you're putting into it, depends what your strategy is. So if it is your first clinic and you're looking to buy into another clinic, then perhaps putting some money down to be able to turn profit quicker is going to be great. So we've done that for some clinic owners, where we'll say, okay, well, what's the planning is pretty easy. You're going to buy a clinic, banks are going to give you the money. That's not really a huge concern. What's step number 2? Do you want to buy another one? Do you want to just let this pay itself off and then start catching up afterwards? And we start doing the numbers for what is your retirement number that you need to get to for you to be able to retire, in your late 40s, early 50s. For the most part, you can still work a little bit if you want to, but what is that number? So in order to hit that number, when do we need to unlock the revenue from this clinic to be able to start investing to get to that number? And that's going to be one indicator of how much money you should put down, because it's just a simple math equation at that point. The other thing is, what is your money doing? So if your money is, getting 20, 30% returns, does it make sense to take that money out and put that into your clinic? Or do you just use the bank's money and then buy yourself some time, do interest-only payments, and then start to do some changes? So it really depends on your experience. It depends on your timeline. It depends on your retirement number. And that, I guess, deal of, are you putting 100% loan to value, 90, 80, 70? It all is going to change for each and every person. So if you hear someone saying 100%, you're good to go, that's not always the right number. What I mostly see is most people don't like doing the 100% because that's obviously in the bank's interest to have all the debt, because your interest payments are way higher to them. So of course they're going to love to do 100% loan to value. It may not always make sense for you, but it really is dependent on the cash flow strategy of what you're trying to do.
Yeah. I think one little like extra
Yeah,
side point to that is, we've seen a couple people that come from a business family that they're starting like business acumen intelligence way higher than the average person. And so for those few individuals, I would call them outliers, to go in 100% finance and be able to turn the business around, understand business principles, really like shrink cost, increase profits. We've got a few of those people that we've come across. Super, super high intelligence when it comes to business. Might make more sense for them to borrow all that money and grow the practice quickly.
Yeah. True points. Okay, we're running a little bit over time than we wanted. So we got three other things to tackle. One of them I'll tackle real quick for you all is is really when it comes to the broker side of it. So, okay, cool. Now you know the banks that gave you money, who's brokering the deal. You really have two decisions to make. And neither one of them is right or wrong. It's just as long as you go into eyes open, you can make your decision. So one approach is the one-stop shop person. So this person's like your mortgage broker, your financial planner, they have their own introductions for you for the accountant, the lawyer. It's a one-stop shop, which is easy. And that's nice, is a premium to be paid for convenience. But just know that it's not really regulated and tracked. So there is no disclosure requirements for them to be getting kickbacks from other people. Generally speaking, the one that's making the sale is paying most of the people's fees. So it's oftentimes in the best interest to pump up that number, is what we've seen sometimes as well. I'm going to this person. Well, that seems a little bit higher than what a comp would dictate you paying for. But at the same time, some people are okay with the convenience and paying the premium for, just buying me my time back. This one person can do it. Sure, I'm paying more money than I probably otherwise would, but I don't have to talk to all these other people. So just make your decision, because there's two approaches. There's the one-stop shop that is most likely going to cost you more for the transaction because there's a potential or strong potential for conflict of interest. And there's referral kickbacks probably happening there as well. So that's one thing. Or the other side is you break it apart and you work with a separate lawyer, separate mortgage person, separate bank, and you kind of have your own connections. That's the way everyone's working in your best interest and they're not connected at all. Not to say one is better than the other, just be aware of what the potential conflicts of interest are. And as long as you're okay with that, we have some people that really like the latter, and we have some people that like to get the time back and do the former as well. So just real quick on that one. Okay, cool. Last two things, Tyson, is patient retention as a valuation tool and variable, and then finishing off with agreements. And we'll tie that back into Dental Corp at the beginning. So when it comes to patient retention, that is probably one of the most important things for you to be looking at. You looked at the EBITDA, the revenue looks great, and the true profit looks great, but couple considerations is you want to look at who's actually working in that clinic.
Yep.
So if you have one dentist, let's say Tyson is the dentist that's working at the clinic, and he's really doing like 90% of the billings and seeing the patients, then doing the production, you want to assume anywhere from a 10 to 25% drop off. And there's a little bit potentially more risk if it's a rural community. Maybe it's a real big family vibe with that person, and there's a new shop in town, again, because they're private, so competition is everything. So you want to be aware of like what's recently opened up around the area, but there's always an inherent risk if there's one dentist that's doing the vast majority of the production, because always assume 10 to 25% drop off of patients, and that is not ideal if it's one person who's a rainmaker, as opposed to if you have associate or associates doing 30 to 50% of the production. That's great, because your patients are conditioned to be able to come in and just see different people. And if your clinic is running that way, it's a lot more feasible for you to have a lot lower end of the drop off or the patient drop off, because they're used to Dr. So-and-so's here, Dr. So-and-so's here this day. And it's just a different vibe on that. So that's one thing you always want to look at, is who is producing the revenue. And that is extremely important for you to look at. As much as you may feel confident that like, I'm the man, people are going to love me and they're going to, want to stay with me. You don't always know that. So assume a big drop off, especially if it's one rainmaker that does it, especially if it's a second generation dentist. We've seen that as well with a couple of years back. We had a client that was looking at that. It was a second generation dentist. So lots of family legacy there. And that was no longer happening. So you would assume we put a higher risk on the retention rate than what the industry standard was. Other thing to look at is active patients. I think, what do we look at? 18 months, I think, Tyson, is trailing 18 months.
Trailing 18 months. Yeah.
Trailing 18. Okay, perfect. Yeah. Trailing 18 months is a good number for an active patient. Honestly, I don't know if I'd be considered an active patient. I remember the last time I went to the dentist. I get the reminders, but my schedule's all crazy. So I apologize to my dentist.
It's so true. How many people follow their 6-month recall schedule or their 9-month recall schedule? I mean, it just doesn't happen.
Yeah.
And so trailing 18 months, I think is fair to give them like something that's reasonable. And also, like, remember, when you're looking at these numbers, this is all recorded history. It has happened. It's no indicator that it's exactly as it's going to happen in the future. The good news is, I think we were talking offline, is dentists and our other niche that we work with is optometrists. It can't be done virtually. You can't convert to like telehealth or teledental, teleoptical. They don't have that. So clients have to come in. You get foot traffic in your clinic, in your dental office. They have to come and see you, and so that is a huge benefit for you.
Absolutely. And yeah, so that's one of the things that's good to keep in mind. So an active patient is trailing 18 months, and then from that number, you can also see what is the symptom of that. So if you're out of that 18 months, you want to look at your like the healthy hygiene recall rates. Are those high? What's the process of there? And that can kind of tell you that story as well. But those are probably the two biggest numbers that we look at. Goodwill is one thing that you always want to be cautious of because that's such a hard thing to quantify. But your active patient and your provider concentration risk are two things you always definitely want to look at.
Yeah, I
All
know.
right.
Sorry, just to add one more point, just because why not
Why
talk some
not?
more. In our industry, when we buy a book of business, we typically use a format that's called an earnout, which would exactly line up with this. Is like you're looking at client base, how many of those clients are you going to retain, how many are going to do repeat business with you, and if there's a significant drop off, that could adjust the payout model over a period of time. So if you're buying at a 3, 5, or a 6x multiple, are you paying that out in one lump sum, or are you paying that out over 3 years? So that's also tax advantaged to the seller so that they don't have a balloon payment with a huge tax bill, is they might get phased payouts and you're spreading it over different calendar tax years. So something to consider maybe with your creative tax and finance team on both ends.
And that was actually a perfect segue to go into our last point for a couple of minutes here. Is we'll talk about agreements and the importance of a lawyer. So lawyers are very valuable, extremely valuable in these types of transactions. And part of that is going to be the agreements that come into it. So the associate agreements, the lease agreements, the purchase agreements, all these shareholder agreements. I think I said enough agreements. I can't remember off the top of my head if I missed one there, but there's a lot of agreements that have to be redone when this transaction happens. Because a lot of times it's a big material change, and sometimes there's assignment things that happen to the landlords. There's some great landlords. We just did a transaction which was probably the worst landlord I've ever experienced. It took so long. It was so difficult to work with them, but we got it done, which is great. So when it comes to agreements and lawyers, what are some important things you want to leave the audience with?
Yeah, I think depending on which point we want to look at. So let's talk first about shareholders agreement. So shareholders agreement is really important if there's more than one partner in your business. What happens if you get sick? What happens if you pass away? What happens if you want a business divorce? What is the agreed upon method, valuation, and separation of these individuals? Also, I mean, this is something that we're starting to see a little bit more of, but I think when you do your shareholders agreement, what happens if you're approached by private equity? Now, we're talking about dental practices, but I have a lot of guys that are in the trades, and the trades are being approached by private equity. So you started out, you're a plumber, you're a electrician, you're a framer, and you never thought that you're going to get a 10x multiple from a private equity fund to sell. Well, your dental shareholder agreement should say, if we're approached by one of these funds, this is our thinking, this is our methodology, this is the terms that we would accept in order to exit. Because the last thing that you want to do is you have 2 or 3 dentists running a corp. 2 of them say, I'd like to take this once in a lifetime payout, sell to private equity, exit early. And then one of them says, no way, Jose, I want to work for another 25 years. Now you're at an impasse. Now what do you do? So shareholders agreement, it gives some rules to the game of like how you should deal with some of these forks in the road. Associate agreement, I think, is one that you brought up is really good. It's like an employment contract, but you're self-employed working for that individual. What are the expectations of the clinic? How are you supposed to operate? How does payout work? If they sell their practice, are you expected to stay? I mean, it's your clients too. You're the associate dentist. You're going to have your own book and your own following of clients that like you and want to deal with you. So these are things that should be talked about. with your legal team. And it doesn't have to be a ton of work, but you should put some thought into it and understand like what this means. And you can always revise these agreements and documents as you evolve as a practitioner. What were some of the other ones that we talked about?
Lease agreements.
Lease agreements. Interesting. So like we're in Vancouver lease agreements with triple net and with all the other things that are involved. You don't own the property, but you pay like you own the property. You want to make sure you're protected from the risk of sudden development syndrome, right? If your property owner, the person that you're leasing from says, I want to sell and they want to build a high rise on this property and you're out in 6 months, are you protected against that in your agreement? Do you want to uproot your clinic and find another clinic in the same neighborhood that's comparable, that's not older or needs a lot of work? I mean, you really want to take these agreements to protect yourself, because we do see that in the Vancouver area. I'm sure it happens in Toronto too. Landlord sells all of their holdings to a development company and then it doesn't get developed for like 10 years. So did you have to leave and like uproot your practice, move somewhere, pay all this startup cost again when you could have just stayed because you had a solid agreement? Something definitely to consider.
Yeah, and I think DMC actually put out a good article, maybe a few months back. I can't remember exactly when, but it was a case study about a demolition clause that the landlord tried to put into a lease agreement upon the sale of it. So dentist one sold to dentist two, and they try to use that opportunity to add a demolition clause. And they disputed it and ended up being like a big litigation thing. So, really what I would say is if you listen to this and you're a potential seller in the next little bit, it's worthwhile to spend the money to make your clinic more attractive in regards to the ease of transition. So having a good assignment clause built around a reasonable assignment for the next one. That was part of why our transaction that we just did was so difficult, because the assignment clause wasn't super advantaged. So we got a discount because of that. And then we had to deal with that whole process, but that was fine. It ended up working out. But making sure an assignment clause is reasonable and it's easy, making sure your associate agreements are written in a way to give as much favorability of the incoming dentist to be able to take over that practice, have some type of retention or a sweetheart bonus. Make sure that your shareholder agreements are done. That doesn't really help you as a seller, really, but unless you're selling to a bigger conglomerate or you have someone that might be a potential dispute. And all things are really good to do when everyone gets along. So all those things are really important to do because, again, I keep saying the same thing. You are private. So, if someone doesn't want to buy your clinic and someone else has made their clinic a lot more attractive, even if it's a higher sale price, that's going to be a better deal for us as buyers potentially coming in and looking at it. Is okay, this one's more expensive, but it has way more favorability. It's going to be a way quicker, cleaner transaction. So we would definitely pay more money on that. You have a better balance of who's doing what billings. We have good agreements that those people are going to stay on, and good commitments that they're going to stay on. All these things are really important to make sure that your clinic is attractive. So that was a lot. What we will do is I'm sure we'll answer some questions. If you have questions, drop them in the comment section on whatever platform you're watching. Also, another reminder for our closed Facebook group for doctors across Canada. I know a lot of you are dentists that have come through our dine-in talks and things of that type that are going to be in that group. So this will be really advantageous for you. And I'm sure we'll probably do a follow-up episode on this one with a lawyer to go some more details, because as we kind of talked through this, I think it's definitely worthwhile to have a lawyer chat about the importance of some of these things and give some perhaps case studies for you guys to learn off of. So a little bit heavier episode. Actually, it wasn't that bad. It was like 50 minutes. So it felt longer than I thought it was. But maybe because of that acronym heavy segment that did kind of threw me through a loop. But that's why we're a team. Tyson simplified that, which is great. So all that being said, we want to leave you with the thought of, as a dentist, you are a private clinic. Buying this clinic that you're going to be looking into is going to be the difference of you buying a landmine or a gold mine. You want to make sure you're looking at the true profit of the clinic. You want to look at the potential risks of the retention. You want to have a strong argument of how do you quantify the goodwill. You want to make sure that you're looking at your options of offering as a share sale, an asset sale. Take a look and seeing what brokers you're going to be using. Are you going to be using a one-stop shop and potentially paying a premium, or are you going to break it apart and have no conflict of interest because you have separate parties doing it? The banks will give you money regardless, but do you want to do 100% loan to value, 90, 80? Make sure you're really talking to your team to get an idea and a roadmap of what this plan is. And the transaction is kind of the easy part. It's really about what's the next step. Are you looking to buy another practice? Are you looking to just use the practice to big condo to retire you? What is the strategy? And I think if you know that and you work backwards, all these other decisions become a lot easier. So we'll leave you on that note. Tyson, any last thoughts?
No, that was a heavy episode. I mean, it's a lot. It's a lot.
I
So
like how
it
we
is.
started the episode by saying this is not going to be a heavy episode, and then ended up being a heavy episode
It
anyways.
ended up being a heavy episode. Yeah. With all of that complication, all of those layers of stuff that we've said, it's still likely easier to buy a practice than to build one from scratch. Like a cold start
Yes.
that's a
The
big
hardest.
uphill battle. So if you're young and you're buying a practice and you can modernize it and add social media and add marketing and really grow the practice that way, because the more mature doctors, they don't like to use technology, computers, social media, all those things. You can have a real advantage and you can use that to your advantage to really grow business. So purchasing is the easier road to having a big business.
Amazing. Thank you so much, everyone. We'll see you on the next episode of Portfolio Talks.